Hello again, class. All right, let's get into chapter 20 stuff. So this will be our information about chapter 20 stuff. Here we go. So we've got to learn some terms about chapter 20. We've got to learn about what the word explicit and implicit means, which was one of the homework questions, one of your study questions. But explicit costs are the costs for paying for using others' resources. So whenever you buy raw materials for a company, that's considered part of explicit costs. If you are implicit costs are the costs of using personal resources in the production of a product. So personal resources might mean warehouse, your own forklifts, even your own labor as the owner might be considered implicit costs. It's implicit because it's the cost of what the self-employed resources could have earned in their best alternative use. So you could have used your warehouse. You could have used your warehouse for something else. You could have rented it out to some other company and made money off of the rent. Your labor, as made the CEO of the company, you could be working somewhere else, making more money. Your forklift truck, again, you could be renting that out to some other company, making money. And so the implicit cost is what you could be doing with the resource that you have. So let's think this through some more by giving you some examples. So our revenue is here. Our foregone wages are the wages we could have gotten with something else. So what do you think? Implicit or explicit? Your foregone wages, what you could have made somewhere else. Hopefully you're thinking implicit. Then, of course, a clerk's salary, explicit or implicit. I'll let you think this through. And after you're done, so you can feel free to pause the video at any point, I'd like you to you go back and look at what the answers are here and check to see if you're getting it right. So here's the correct answers. Your explicit costs should have added up to 63,000. Your implicit costs should have added up to 33,000. And of course, you're going to take that away from your revenue, and you're going to find your economic profit. You notice here there's another thing here called accounting profit. Accounting profit is larger than your economic profit. And that's because accounting profit only takes into consideration your explicit costs, whereas economic profit considers your implicit costs. So anyways, I'll show you another image here to make you understand this. But you could feel to brainstorm this some more if you wanted to by thinking about what a manufacturer, a retailer, a farmer, or a service provider, what sort of explicit and implicit costs they might have. But we're not going to do that today. So here's a big bunch of definitions of these different terms. But let's break it down first again. Accounting profit. It is your total revenue minus your explicit costs. So pretty simple, right? Total revenue minus explicit costs. That's accounting profit. Let's go a step more complicated now. Let's add in economic profit. Economic profit, sometimes called pure profit, or sometimes called above normal profit. These are all things called economic profit. And the way you find that is just you take your total revenue minus your economic costs. So that's going to include your explicit and implicit. So again, economic cost is your explicit costs plus your implicit costs, which sometimes is called your normal profit. I know it's weird to have something that's considered a cost be called normal profit. Yeah, anyways. Then another phrase here to expand on more is what is economic cost? Again, we said it's explicit costs plus implicit costs. But let's break down this normal profit definition a little bit more. My definition is the cost of obtaining and keeping entrepreneurial ability implicit. Uh, so, anyways, if I am the CEO of a company and I am not making enough money at my current position to keep the entrepreneurial ability at this company, then I might close up shop and go somewhere else, right? So it's the implicit cost, or you need to be making a normal profit um, to keep yourself working at that company. So it's weird to call it a normal, this implicit cost of normal profit, but you have to make that much money in revenue to keep your entrepreneurial ability in the long run. And so that's why it's called normal profit, even though it kind of is more of a cost, but it's an implicit cost. So I'm going to have us watch a video here a little later. And I'm going to post this PowerPoint on Canvas. You can feel free to look at the video too. We're going to force you to think about what is an implicit cost and explicit cost. So again, here's another image of what we're talking about. You've got total revenue, and you have accounting profit is going to be part of your total revenue. And the other part of your total revenue has to go towards your costs. Those are going to be your explicit costs. Now, economic profit is again a lot smaller than accounting profit. And that's because accounting profit, not only does it include the explicit costs like accounting profit, but it also includes implicit costs. And so sometimes we call those, like it says here, normal profit or economic costs, economic opportunity costs. So hopefully you get those terms at this point. Now let's move on to some other terms. Marginal product. So imagine Mr. Hansen has a blue jean factory. And so every day I go down to my basement where I am right now and I sew up some blue jeans to sell in the economy. And so it takes me, for every day, I only make one pair of blue jeans a day. And so my marginal product for the day is one pair of blue jeans. And of course, let's say people love my blue jeans and things are going awesome. So I hire another worker. I hire my wife. She starts working with me. And so instead of making one pair of jeans, I hire my wife, and now I'm making 4 pairs of blue jeans a day. So my marginal product now is how much more jeans I made per worker. So it's again, the definition here is the change in total output brought about by adding one more worker. Well, I added my wife, so that's one more worker. She added 3 more jeans, so my total jean production now per day is 4 jeans per day, which is awesome. And let's say I hire my neighbor to start coming over here and working for me, and that neighbor makes me start to, I can specialize more. I can sew. Well, I wouldn't really sew. I'd probably cut, and my wife would sew, and then my neighbor maybe they would I don't know, clean up and do other stuff. But we start to specialize, and as a result of specializing, we would increase our marginal product. Again, it's where specialization is where a worker focuses on a specific aspect of production. And so hopefully our marginal product will continue to rise as we hire more and more workers. However, so yeah, we would call this increasing returns as our marginal product increases. Maybe, again, I'm going to focus on cutting. My wife is going to focus on sewing. My neighbor is going to focus on dyeing the blue jeans blue or pink, whatever. And eventually, as I hire more and more workers, we're going to experience diminishing returns, or I like to call it too many butts in the kitchen. Maybe you've heard of too many cooks in the kitchen. Either way, it's a situation in which workers cause marginal product to grow at a decreasing rate. So if I hire more and more of my neighbors, eventually there comes a point where we start to get in each other's way. My basement's only so big, and so we end up actually every worker I hire, let's say my fifth worker I hire to work for my blue jeans company ends up only making 2 blue jeans more. Well, as before, my last worker was, 6 blue jeans. And so my marginal product just started to go down. My total product still rising, but my marginal product just went down. That's called diminishing returns. And that's probably not the best place to be. And so you can look at this example, and can you tell me what number of workers do we experience diminishing returns? I'll let you take a moment and think about that. But how many workers do I start to experience diminishing returns? Well, let's see here. Marginal product is 3, 4, 5, 7, 10. It's 13. It's rising still. And all of a sudden, boom, at number 7, number of workers, my marginal product diminishes. My total product's rising still, but my marginal product's diminishing. So I am reaching diminishing returns, or too many butts in the kitchen, at 7 workers. And eventually, this leads to negative, and my total product starts to go down. Now, how do you calculate marginal product again? Well, you take your total product from the previous, and you subtract, find the difference, and that is, one other thing I forgot. Sometimes they'll tell you to find the change from 1 worker to 5. Although most of the time it's just what's the change in 1 worker. So it's easy in this case because you're just finding the change in total product. But anyways, feel free to reference your formula sheet that I've given you guys to look at the official formula. But anyways, it's important you understand the formula. All right, I'm going to move on here. And let's talk about another term here. It's called fixed costs. Fixed costs are just like this lighthouse. They are stationary. No matter what's going on, they're still fixed. So right now, even though some businesses might not be working at all, they're still having to pay rent. Those are considered fixed costs. Whereas variable costs are costs that depend on the level of production of outputs. So currently right now, some companies might have a ton of output. They're making a lot more things because demand is really high. Of course, toilet paper might be one thing that's really high right now. You name it, right? And so the variable costs are very high right now for those companies, whereas some companies, they're not making anything right now. And so as a result, the variable costs are really low or non-existent because they're shut down altogether. And so let me ask the next question. How do you think you find total costs? Well, fixed plus variable is the answer, right? And so depending on the type of company will depend on what sort of fixed costs and variable costs you have. And in this activity, I would normally have students find, is advertising, what do you think? Is it usually a fixed or a variable cost? Fuel for your company, is it usually a fixed or a variable cost? Well, all of these answers will depend in a lot of different circumstances on what type of company you're dealing with. Most of the time, though, I'm going to say advertising is probably more on the fixed end of things. Fuel is more on the variable end. Interest on company issued bonds is more fixed. And let's talk about why for a second. Advertising, you're going to advertise. You're going to have your billboard out there that advertises, your product every month. You have to pay that fee every month, whether you're making $1 million, whether you're making 2, right? And so the advertising is more of a fixed cost, whereas fuel is more variable. If you're making $1 million, you're going to spend a lot more money on trucks, transporting things. So that's more variable. Whereas interest on company issued bonds, again, your interest, you still have to pay that every month. And so that's, again, a fixed cost. Doesn't matter whether you make $1 million or 2, you still have to pay that interest monthly. So that's a fixed cost. Shipping, again, kind of goes along with that. Fuel can be variable. And again, I'll let you think through the rest of them on your own. So now let's talk about some other terms. We've got short run. Short run, we've talked about this before, but let's reiterate what it means. It's a period of time too short to increase a plant's capacity. So it's a time where you cannot buy extra land to increase your plant's capacity. You can get maybe some more workers on the assembly line, but you cannot increase your plant's capacity by getting more land, and therefore that would be the short run. Now, the long run is a period of time in which you can get more land, and it's also a time in which other people can join the market, or people can leave the market, and so that's the long run. Now, a market period is a period in which producers are unable to change anything because the time is just too short. The information just hit the newsstands. So at that point, it's perfectly inelastic supply. You cannot change your supply. That's considered a market period. As soon as you start to get more workers on the floor and up your production, then you're beyond the market period and you're into the short run. Another term we need to know is total cost. We talked about this earlier. It's variable costs plus fixed costs. Adding up all your variable costs and all your fixed costs to find your total cost. It's the sum of them, right? Pretty easy. Marginal cost, and again, feel free to reference your formula sheet that I gave you guys. And if you need an extra one, feel free to email me. The formula for marginal cost is change in total cost divided by change in total product. And it gives you an idea of how productive you are as a company. Because if your marginal costs are rising, it's a bad sign. If your marginal costs are diminishing, that's maybe a good sign for your productivity. And so you're going to want to look at marginal cost in relation to marginal revenue and things like that moving forward. But it's a change in total cost divided by a change in total product. So here's a bunch of the different terms we've talked about so far. And here's all the different formulas for calculating them. I'm not going to go over them now, but you can feel free to reference them, pause the video, and come back to them later. And normally I would have you practice these things, but I'll give you the freedom to do that on your own and answer these questions. And but I'm going to move on here. I'm going to talk about another term called marginal revenue. Marginal revenue is how much you make per unit you sell. So let's say there's this shirt at Old Navy, which I found hilarious, so I took a picture of it. Or maybe you like this shirt and said Old Ghetto. Whatever the product is, whatever the price you're selling it as, that is your marginal revenue. So let me ask you this question. When does marginal revenue change? Well, the answer to that question is marginal revenue changes when your price changes. So if you're selling a shirt for $15 and it goes on sale because people aren't buying it because it's a weird shirt, then maybe you go to $10. Well, guess what? The marginal revenue, the revenue received for each unit just went down now, right? But let's say it's Old Ghetto. Everyone loves Old Ghetto, right? And so you raise the price to $20. Well, now instead of $15 per unit, you're now making $20. Your marginal revenue is increasing, right? So marginal revenue and price are sometimes the same thing. Oftentimes they're considered the same thing. All right, so total revenue is something we've already talked about. We did the total revenue test for finding elasticity. Just a reminder, it's price times quantity, right? And total revenue is not your profit, right? Your profit is subtracting your costs, implicit or explicit, right? Now, what is your profit maximizing output? The reason why we care about all these different costs is so we can find what is our profit maximizing output. And so It's a level of production at which the business has realized their greatest amount of profit. Should make sense. It's in the name, right? So where is the profit maximizing output? Well, it is when marginal revenue equals marginal costs. That's where we're gonna, from the rest of, you're gonna hear that a lot. So always look, the key, always look, where's marginal cost and where's marginal revenue equal? And that's where you're gonna always look to find your profit maximizing output, okay? How many units are you gonna produce? So let's look at this next bit of data. Let me ask a question. What is the output at which we are experiencing the most profit? Well, it should be pretty obvious. It's going to be where marginal cost and marginal revenue are equal. Well, if we go down here, 20 and 20, so at 9 workers, that's where their marginal revenue and marginal cost are the same. And look, our profit is the most at that point, so it makes sense. That's our profit maximizing point. But sometimes they won't give you the profit column, and you'll just have to look at MR for marginal revenue and MC. Now, we still have not answered the question. What is the profit maximizing output? Well, the profit maximizing output is 66 units. And so you'll have to do that with charts and graphs moving forward a lot. I'm going to give you a few more terms, and then we're going to be done with our video for today. Now's a chance for you guys to get your extra mulligan. I want you guys to email me. I'm going to link this video, and I want you guys to watch it. I want you to tell me what is the implicit costs and the economic profit that this person on Shark Tank is experiencing. And so that'll be your way of getting your extra credit mulligan. And also, when you email me the implicit costs and the economic profit, please also share with me what you've been up to during this time, and any questions you might have. So we've got a few more slides here, and then we're going to end our video for the day. So diseconomies of scale. There's economies of scale when you up your production and it lowers your costs. But there's also a point of diseconomies of scale where as you try and grow, you'll have diseconomies of scale. And when you watch the Shark Tank example, you're going to see some diseconomies of scale where as this person is trying to increase their production, they're experiencing higher costs. And so they're trying to meet up with a Shark Tank person to create economies of scale where they can up their production and have lower costs. And so there's many examples of diseconomies of scale, things that make it that as you up production, you actually raise your costs. There's more regulatory costs sometimes if you're a larger company. There's more office politics you have to deal with, which lowers your, increases your opportunity costs. There's a principal agent problem where your board of directors ends up your CEOs and things like that don't care that much about the management of the company in the long term. They care more about how the stock is doing in the short run. And a lot of these board of directors are likely to leave the companies and jump to some other big company. So that's another problem if you become a really big company to try and up your output, that you have principal agent problems. The people on top don't care so much about the longevity of the company. Um, Risk aversion, waste, inefficiency in general, just rising costs of complexity. There's lots of different things that can add to diseconomies of scale. And so anyways, feel free to be working on your homework. I hope you're doing well. Please give me an update on how you're doing. All right, bye for now.